And we're recording.
And we're recording.
Okay. We are recording. What up, Deborah?
What up, Mark? Hey, so we're super excited today because on a whim, we decided to bring a special friend to talk about buy down rates and all this other garbage, right? So
Absolutely.
Mark and I are bringing on David.
David Wo-Mann, what up? So now we got a couple of regions in the United States covered in this discussion. And Deborah brought a great topic to the table today, and we want to discuss it. And having the most perspectives, in my opinion, is always the best way to go about anything. So, Deborah, you want to tell us what we're talking about today?
I kind of feel like I'm in a Deborah sandwich.
You are.
This topic came across my email a couple of times, and it was on the feeling of are buy down points worthwhile, and Freddie Mac, and I think it's Yahoo Finance. I don't remember. There's a couple people that have come out and said, it really wasn't worth it. And it wasn't worth it in 2023, and it wasn't worth it in 2024. I don't think it's been worth it since 1999. So I don't really. Anyway, so yeah, buy down points and permanent buy downs. That's what we're talking about. Not temporary, actually permanently buying down the interest rate and how much it costs to get there. So hook us up with the article.
Yeah, before I pull the article up, I want to make sure to clarify, we're not talking about temporary buy downs like lower interest rate for the first year, increases the second year, third year. That's what you get. Essentially, the sellers are paying all of that, preloading the interest for it to being able to allow the customers. You're talking about if rates are posted at 7.5, buyer takes their money or seller's money and pays to buy that rate down to 7%, right?
Yes. And while you're pulling that up, let's tell everybody out here who David Wo-Mann is. So
please,
David Wo-Mann got roped into our little circle here just this morning. But he poor guy.
What was that?
Oh, can you guys hear me?
We can now.
Lovely IMs and DMs. You know, the quick little chat like, hey, we have a treat for you today. And then I took it hook, line, and sinker. What do you guys got? Oh, you get to be a guest today. Perfect.
Yeah, I think it's exciting. Perfect. So David is our branch manager I never remember which branch you're in.
He's over in Oregon, up in Salem or somewhere around there. David's frozen. There we go. He's back.
You're back. Okay, yeah, he's in Oregon, but I never remember actually like where his branch is located.
I'm back.
He's having technical
We don't have very good internet out here. We're in
good.
Oregon. We've got dirt floors out here.
You ride your horse to your office in the morning? Okay.
That's up here. Yeah. That's down here in Texas. Man.
All right. Okay, well, pull up the article while we get David back.
There you go. You're back. I think.
Maybe.
If he's not, let's talk about this article. Yep. Okay, so this is talking about buying down mortgage rates. And let me pull this down below so that I can read this article for us. Okay, buying down mortgage rates wasn't worth it in 2023, experts say, and it won't be worth it in 2024. Rate buydowns jump in popularity last year aimed high rates and elevated home prices. Let's see here. It says, as mortgage rates launched to a 23-year high in 2023, more home buyers paid extra discount points to buy down their mortgage rate. But it may not have been worth it. According to Freddie Mac, more than half of the U.S. buyers paid discount points last year, as a substantial jump from recent years, as they contended with their double whammy of elevated home prices and mortgage rates in the 7% range. Also known as a rate buy down. Discount points are mortgage interest you pay up front at closing to get a smaller percentage knocked off of your rate.
Small percentage
knocked off of your rate.
Small percentage.
Yeah, huge dollars, small percentage. Correct. Despite homebuyers in 2023 buying more points, Freddie Mac found that the interest rate differential, was negligible. Through November, the average rate for purchase buyers paying discount points was 6.61% versus 6.69% for those who didn't pay points. That's only an 8 basis point difference. The result seems to suggest that paying discount points may not be worth it from the consumer's point of view, Freddie Mac researchers wrote. The reports sampled borrowers with credit scores at a 740 and loan to value between 75% and 80%. About 59% of purchase buyers paid discount points in 2023 compared with 31% and 54% of purchase borrowers in 2021 and 2022 respectively. The trend was even more pronounced among people refinancing their mortgages. More than 82% of cash out refinances and almost 60% of non-cash out refinances chose to buy down their rate. The result underscore how financially hard pressed some buyers may have felt last year as rates surged towards 7%, with more folks looking for their last shot at relief through incentives such as rate buydowns. As interest rates have increased, I think buyers who are looking for ways they can try to mitigate those costs. Lynn Kiefer, deputy chief economist at Freddie Mac, told Yahoo Finance, when they're paying points, it's reflected of very high interest rate environment we are in relatively to the recent years. And then it goes on, discount points may not be worth it. 1 point typically cost 1% of the loan amount on a $400,000. It equals to $4,000. The discount points typically take between an eighth or 1.25 to a quarter 0.25 off of the interest rate, meaning mortgage rate that is 6.75 would inch down to maybe 6.5%.
And cost you $4,000 to get there.
And cost you $4,000 to get there. So
I think that's the nuts and bolts of it.
Let's talk about it. Let's talk about it. Who wants
Mr. Doman.
David, give us your 2 cents since you're the guest.
Can we just reflect really quickly?
We can.
On the fact that they said typically 1% is, or 1 point is typically 1%. And it's 1 point is 1%. It's not
correct.
Typically, there's no room for error. It's just 1 point.
No, it always is. Yes.
It always is. What's that? You probably know that line. It's out of old school, right? It's like it works 100% of the time, 80% of the time.
No, it's actually from Anchorman, and it's 60% of the time. It works every time.
What's the
Sex
cologne?
Panther cologne.
Yeah.
Yes. Wow.
Anyways, my guts. It's an interesting one because the first thing I look at from as a branch manager standpoint is that we see the back end too. We don't just see what the consumer sees and feels.
Right.
And, from a consumer facing side of things, it maybe doesn't feel good when you look at it from oh, hey, rates are going to drop. Let's refi. Boom. Those points are gone. We can talk about it more in depth, I guess. But if you look at the margins or the profit in the loans, mortgage companies have had a larger spread for those points. Right. So, with the lack of money or income in each single loan, companies have to make money, right? And most mortgage companies have been losing money for the last year or two anyways. Those points historically they go away or go down when the market has more money in a loan. So if you look back, actually Freddie's website is fantastic for tracking the last probably 50 years or 60 years. I think since the 70s. So 50 years
72,
roughly.
Yep.
72. So we have 51 years of data, right? Going on 50 plus, So my point is it'll tell you the average points also, right? That were paid for that rate. So you can see when profit had been stripped out of doing mortgages, people paid more points because a point would buy you more. Right. So if we went back to 2020 or 2021, 1 point might buy you 0.25% of interest. But the last, let's say 18 months on a lot of people's rate sheets, 1 point could buy you 1%. Um,
Right.
would be my, if we went back and looked at rate sheets, I would say that that would be one of the big things. So my thing is that rate reflects ego too.
Hmm.
And
Okay, so I have a
you,
question.
yeah,
You just said that in the last 18 months, that 1 point would actually buy down the rate 1%?
He was
I
just
would say
saying
that.
in some instances, because, and I think you correct me if I'm wrong, David, but I like this line of thought is there are many cases that the mortgage company that is lending the funds to the consumer based on, let's say, their credit score, demographics in certain regions,
Mhm,
um, could not price a loan without charging something to the
correct,
borrower. So,
correct,
for example, they didn't have an option. I mean, a mortgage company can't just lock in the loan because it's an option. There's a profit margin or a spread that needs to be made. And the goal is it's an even profit margin across all loans so that there's no discrimination based on different program, things of that nature. But like you said, for about past 18 months, consumers had to pay minimum a point to even lock in their rate. So is it considered a discount point? Yes, it is. But it's also the difference between you getting this home or not getting this loan,
yep,
which
Yeah,
that's
I
a
think
great point.
I do. I agree with that. I have never been a fan of discount points ever. And
Yeah.
I made the joke earlier that and maybe back in 1999 because that there was a spread there. Like it would make sense that okay, I could lock your rate at 8.5%, but hey, if you want to pay 1%, then we can actually get you down to 8 or 7.75. You run the math on that, and it kind of made sense. There just isn't the margin there. We're dealing more exactly what you said, Mark, was it the rate sheet says 7.5. That's as high as the rate sheet even allows.
That's
That's
it.
where
Yeah.
everything's selling at, and it's gonna cost you a point just to lock 7.5, so take the rate or don't buy the house, like, that's where it's at.
Right. And I
but I
think
really think
inside,
that
go
the
ahead.
ego thing, I think the ego thing comes into play because I can't tell you how many times I've shown a client, "Hey, take the higher rate, pay less fees,
Hmm.
and or here is an option where you pay more fees." And a a huge amount of time, they pick the lower rate and
Hmm.
the higher fees. And and that's not because as an advisor, we're still advising them and giving them options,
Right.
but that's their ego saying, "I can't have a 7+% rate. I'd rather have a 6.99 rate and pay a point and a half or whatever it's been over the years." So I think
Because
Matter
ego.
of fact,
everybody looks at your mortgage statements when they have dinner on Saturday nights, so
no,
that
they
would be
don't, Deb. You've got a good point there, but I think with the rollout and adoption of social media and the trends, we've benefited from it, but it also has kind of misshaped the consumer to the point that they have to do what their friends are doing. And the first one that has that sub 7% rate, I'm not cool unless I can talk about that part of what I just accomplished, if that makes sense. It's a false sense of um, I don't know, like a clout. I don't even truly understand that word, but I think it's clout that these kids are trying to get. um, but as a professional expert loan officer that we are, we bring up when we're talking to a customer that's having to make this decision, break even point.
Mhm.
And what I can do is probably throw up right now something on the screen that shows you how to calculate your break even point for any situation that you're actually having to pay money to get something lowered. Calculate it, make it, take the emotion out of it, and just make it a logical decision. But like David said, there are some people that you could literally show them the advantage and the savings and how long they would have to be in their home for them to actually make money from that decision to buy down the rate. And they'd still go, no, I think I'm going to buy down that rate.
Yeah. Yeah,
You
you're
know,
right. It's gonna take you 15.5 years to make up what you just did. That's okay. I wanna be able to tell my buddy I got a 6.99 rate. Okay.
exactly. That's
Do you have a
literally, I
big
think,
truck
what I'm
too? A
saying.
big lifted truck and,
Huge
little
truck.
man syndrome or something? I don't know. Sorry, side note.
Now, question for you guys. Do you think that kind of what David was talking about in regards to not being able to price a loan? And I mean, we're just now starting to see 100 again on our par sheet on our in our pricing. I would think it has a lot to do with the investor's appetite in addition to their foresight of what's going to come. So essentially, they want consumers to put some skin in the game on a 30-year loan that they know is more than likely going to be paid off within the next 5 years because of a refinance.
Yeah. You
Mhm.
you you used to throw in a little bit here when you're starting to compare fixed rates to ARMs. It's the
Yeah.
same kind of concept. ARMs used to be a big enough spread that you could justify doing an ARM, and right now I've pulled a couple and I'm thinking that quarter to 3/8% that you're gonna get to go on an ARM,
Yeah.
take the higher rate, be on a 30-year fix because who knows what the Yoo-hoos in Washington, DC are gonna do. So I the spread is there in certain loan programs, but your riskier things or certain investors buying at certain loan pools, they're going to make sure that their money's made.
Right.
Plain and simple.
Now, from a consumer standpoint, I believe, and I just thought of this, I believe that they have two choices to make, and or they have a choice to make, and they're making it for one of two reasons. Reason number one is I want to save money on my monthly expenses or how much I have coming out each month to pay for this mortgage. Um, Reason number two is I want to have the lowest rate, and it doesn't matter what the monthly is. They don't pay attention to that piece of it, but them wanting to have a lower payment for that priced home, does it make sense for the time being? Sure, it may. In many cases, if you have enough funds from the seller to buy down that rate and that payment goes in that comfort zone, sure, no problem. That's what you were trying to fulfill right now. But at the same on the same token, as a loan officer, I feel a little uneasy when we're trying to put a borrower into a mortgage program and the only way that they feel comfortable is we bought down the rate. Because what ends up happening as a home buyer is your insurance is going to go up, your taxes are going to go up. So therefore, if you feel comfortable right now, next year you're not.
Yeah. Yeah, the price of increase is coming. Yeah.
Mm-hmm.
How
Yeah.
often do you think, David, in your market over there, how often are you having that conversation that you're having to make the decision or help people make the decision of discount points or not?
I think that I think we have them most of the time with every client. Um, and one of the things that we try really hard to do with our clients is educating them on a fee and profit or an expense associated with a loan can be called or shown different ways. And um, you know, there's some people in our area that are advertising free refinances. And don't get me started. That's a whole nother podcast, right?
Next week topic, free refinances.
Free
How the
refinances and why
consumer still takes it in the
No
shorts.
lender fee refinances.
yeah, no lender fees, but all the other fees are applicable. And oh, by the way, we'll make the money baked into the rate, right? So we tell our clients that, companies need to make money in order to like be alive and well and pay their employees and stuff. And there's certain things that we have to cover. And you're either going to see that all in the rate, all in the fees, or a blend of both.
Mhm.
And so I would be really super curious, and there's probably no way to do it, but everybody shows their rate sheet, or a lot of places show their rate sheets different. You could charge a 1% origination, which looks at as an origination points and fees. And then the guy down the street or gal down the street could show 1% in a discount fee, but price the exact same rate and the exact same amount of fees. It's just shown how is it shown to the client.
Mhm.
So we try to pause and show our clients, look, my 1% in fees is the exact same as the other person's 1% in fees. It doesn't matter what line it goes on. Okay. And it does. But to the client, it doesn't really matter. We could call it the sky is blue fee and it's still 1%. Right.
Mhm.
So to the client, I think that we have all these federal disclosures we follow, right? Loan estimates and closing disclosures and stuff like that, which our compliance department all follows and we do. And every company should be doing it. But we also want to educate the client also along the way. And so I think that's really important too, because we could be calling one company could be calling it a point for the rate. The other company could be calling it a point in origination. and it's the same exact thing.
Mhm.
So I think what we try to do is to circle back to your original question, Deb, is that we just try to slow down and show the client, look, here's how fees are charged. Here's the realm of what's being charged. Here's what, the average rates are right now across the board. And here's how we've set it up. And then we give them multiple options within that setup.
I think my funnest advertisement that floated around for a while, and I had to jump on the phone with a real estate agent to try to figure out what they were doing. I don't know if you guys saw this in your area, but everybody was throwing out the 5.99 rate, 30-year fixed for a period of time. And if you read the fine print, it was use our preferred lender, this builder will do this, or this contractor will do this, or whatever. But it was going to be 3 discount points to get that 5.99. And
Mhm.
so the contractor working with the preferred lender just increased their price to absorb their 3% discount point to be able to advertise that 5.99 rate. So when
Mhm.
we actually dove into it and read the fine print, and I had this conversation with the real estate agent, like, how are they able to do this? Because my brain automatically just saw the 5.99, and I'm looking at my rate sheet and I'm like, how the freak are people doing this? 5.99 is like clear down here. It's going to cost so much money. And I thought, oh, that's how they're doing it, because the
Yeah.
builder had worked in the cost to be able to pay 3% and a discount point, and they bought the rate all the way down, which is great. The consumer's still paying for it. That's great. You have a 5.99 rate, especially now with the feds doing what they've
Yeah.
done, or whoever we want to blame for the interest rates being as high as they are right now. But it's still the fact of, borrower, you're paying, on a $500,000 house, you're essentially paying $15,000 more for that home. So are you
Mhm.
better served to take a 7.25 or 7.5 rate and get a $485,000 house? I mean, that's the part that consumers just saw 5.99 and jumped. They didn't
Mhm.
even pause to see what adjustment could be made to that purchase price that would have helped them in the future to have a little bit
Yeah.
of equity.
And how
I've
does
got
that hurt
I've got
them, right?
correct. And,
How
and
does
I've
that
got
hurt?
quite a bit of light to shed on this. And I don't know how saturated you guys' market is with new construction, but in our immediate realm of San Antonio, it's all new construction. Your DR Hortons, your Lennars, your Perry Home. We've got all the track builders here. And we saw probably the most shift in our market from purchases to new home purchases. Overall, the United States this past year saw the largest amount of new construction sold since 2008. But at the same time, it was also the lowest amount of pre owned homes sold since 2008 at the same time. So the builders have this, I don't know, dilemma, which is, do we lower our sales prices to meet the demand, or do we keep our sales prices higher and move that money over to bulks of rates we're seeing like 4.99 still
Oh,
with
oh,
competitive builders. So what they're doing is, let's say the home was raised all the way over the last 3 years from 200 to 300. They're leaving that home at the 300 price point, taking, let's say, 40 grand, 30 grand behind the scenes and buying all of these rates for the consumer, because we know darn well that you can't buy down the rate that much and it not be a violation. For example, FHA max 6% concessions. They're going well over that to get those rates.
Mhm.
So in turn, it's like they're washing the money behind the scenes to keep the neighbor who just bought before this debacle from being upset because they just sold that same house next
Mhm.
door for 100 grand less,
Mhm.
you know? So in those cases, I mean, I was just talking to one of long-term time realtors literally right before we got on this on an episode, and he sells a ton of new construction. And I have to agree with him because it is the right thing for the borrower. And if I asked him, I said, so what if this buyer is a savvy buyer and says, I don't want that rate? Matter of fact, take the financing out of the equation. I'm going to pay cash. Now, all that money that you were going to be using to buy down my rate, because I know it's more than 3-6 points to get down to that rate that you're offering, take it off the price of the home. They'll tell them no, go somewhere else.
is that what he said?
Crazy.
Really?
Yeah, absolutely. I mean, wouldn't
Yeah.
you? I mean, at the end of the day, it's going to mess up your comps. the person that
that's
store's going to
right.
get
Yeah,
pissed
I'm like,
off.
why? Oh yeah, comps. Hello.
Yeah,
Yeah,
all of the
you're right. Your
things
appraisal.
there. The new construction market is controlling our market, in my opinion. I mean, in
Yeah,
our neck of the woods, I don't know how much new construction volume you guys are seeing. I know they have to go to their preferred lender at least first. And in some cases, they're not even allowing a turn down look to it. They're on to the next one. So it's just
I
that
don't.
weird nuanced situation to where you have to kind of take the buy down if you want to go that route. Was it beneficial? Well, I don't know any other option because that's the only option I was provided.
See, in that situation, personally, when I'm looking at numbers, if a client really, really, really wants to spend money, right? Because spending money is fun, it's burning a hole in someone's pocket, right?
Yeah.
So one of the things I suggest is let's look at a buy down, not a discount point.
Hmm.
Because if you're a betting person, most people betting last year, even right now, think rates are going to go down. So if they're good with that, taking the higher rate undiscounted, right,
Hmm.
in what we're talking about, and then if we can point them towards a large, 3, 2, 1 buy down or something like that, which is a lot
Sure.
of dollars, at least that money's not gone. Um, we can see where it went. Um,
Yeah.
and so sometimes I've tried showing clients, like, look, instead of doing a permanent 1% buy down, do a 1 year or 2 year buy down. Might cost you a little bit more than that 1% if we're using 1% as the
Sure.
number. Um, but at least that money's gone. And if you refinance, it's still not gone. It comes back as, maybe a principal reduction or just cash in hand.
Right.
Which both ways, you still know where the money is at least, right?
See, and I wonder if that's something that uh, one could put together a solid pack to go after these new construction homes, because that would be the best option, in my opinion, if you have that amount of chunk of change. But oddly, they don't offer that, because if you did offer that, you'd have to now show how much you actually contributed to the deal. And
Hmm.
that cannot be seen because it's far too much that
Hmm.
exceeds whatever the max seller contribution is. Does
Hmm.
that
Yeah,
make sense?
Yep.
yeah.
Wow.
It doesn't just make
I
sense.
mean, you
It is correct. And
wow.
and the other downside too is like, if you look at a client, uh, the big buy downs and the high LTVs, right? So for anybody listening that doesn't understand loan to value, right? So low cash down, high loan on what home is worth. If you have a house that, let's say you put 3% down on, and you spend 2 points buying, or a point buying the rate down, you, in a lot of cases, let's say the market goes flat or flat-ish, and you want to refi. Well, there's a lot of lenders out there right now selling, well, just refi, just refi, just refi, right? Well, what if you only put down 3% and the market goes flat? And what if you can't refi? Wouldn't you rather have that cash in the bank to help supplement your payment a little bit or something like that?
Mhm.
That's another one that I'm coaching our realtors, or our realtors and our lend and my lending loan officers, that, hey, look, if it's, let's just use round numbers. If it's a $10,000 or let's just say $6,000 buyout, $6,000 to buy your rate down for on a 2-1 buy down. So 2% below market rate on the first year, and then 1% on the second year, right? Let's say it costs $6,000 just for round numbers. Well, you have two choices, right? You could take out, or if it was a $12,000, actually, is what it'd be. So
Okay.
it'd be
Yeah.
$500 a month. You could technically like, you could like supplement your monthly payment $500 a month. Okay,
And that's essentially what the buy down is,
it
that
is.
they don't understand the flip side of. They're literally collecting the interest to fulfill the need of that first year and the second year, and then now you're back to normal. And if I'm not mistaken, now mind you, I have not actually closed one of those because I wasn't all the way for it, just doing the math in many situations.
Mhm.
Some work perfectly, but I'm told that if you happen to refinance, the money that you paid up front, if it wasn't used to pull from, it gets back to you
Mhm.
some way, somehow. I haven't
Mhm.
seen it happen, but in the next
But what
6 months to a year, we're definitely going to see that.
what if you need that money?
Yeah, good
What if you
point.
need that money? What if a year from when you do it, or 18 months when you do it, you need access to that little bit of cash to help with the
Yeah.
refi and pay for an appraisal? I don't know. There's a lot of what ifs. And so I'm a big fan of, if you can maintain control of your money and know where it's at and manage your expense, then you're in a safer spot than having an unmanaged or unmanageable expense, which is why we're pro home ownership, right? We're team pro on that.
Right.
And then, but where your money goes and sits, you also want to know where that is. And
So
it's,
also, oh, sorry. Go ahead.
yeah,
Sorry.
go.
I thought you were done.
No, that's it. I mean, if you can manage your money and know where it's at and have access to it, that just lets you be more flexible as the market or rates change.
So I when 2-1 buydowns first came out, I was very anti. I ran around my office and I said, everybody's sales tactic right now is this 2-1 buydown crap, and we're not doing it. I won't do it. And then
I
I
was with
dove
you on
into
that
it
one,
and
Deb.
learned a little bit about it. And a few months ago, I bought a house down in southern Utah, and I did the 2-1 buydown because I wanted. First of all, I feel like rates are going to come down because my freaking rate sucks on that house. So I'm going to refinance the minute that I can. But I also like, how better served am I as to teach a consumer when I have lived that? My life has
I
walked
thought
down the
it.
path of a 2-1 buydown.
I thought it was
So,
because a good salesman likes to be sold.
oh, something like that. Yeah. Here's the thing about it though, is I have very little documentation on what is going on with that money. So I've reached out to the servicer and said, I know how much money was taken at closing because I have this cool little line item on my closing paper,
Yep.
but where is it at? Oh, we have that on our end. Can I see it? I don't know that we really have anything we can give you.
Mhm.
Oh, okay. So I'm gonna call back one more time and see if I can get a different person. But I'm like, how is that not just
I'm
like an
curious to
escrow
know.
account?
Yeah.
Like, I should be able to have an escrow account analyzation and have them be able to show me or tell me what's in my escrow account. But the gal I had on the phone couldn't even tell me what's sitting in that 2-1 buy down account to subsidize.
I wonder
That's a
if that
good
actually
point.
falls under the, I'm gonna call it the escrow, like, protection acts and stuff like that. I don't remember the exact words. And I did see some stuff recently where they were trying to change some of those rules, um, to where I think some consumer activists and or groups and stuff like that, which I think is kind of a good idea, but would actually have to pay the consumer a little bit of money on the money that's sitting there.
I
Oh,
was
Um,
going
yeah.
to say the same thing. That's basically what
yeah.
they're doing, similar to an escrow account, is once they built up a fund large enough that they could at least guarantee themselves that they'd make 1% in this year and another 1% in the second year over and above what they're doing, or discounting the rate. Because keep it in mind, they've got everybody's money going into this big, massive account, just like escrow funds with banks and things of that nature. And first thing I tell someone is, are you able to manage your money? Yes. Okay. If the answer is yes, then would you rather make money on your money, or do you want to have the bank make money on your money? Because either way, the money's due at the end of the year type concept.
Well, it'd be
Mhm.
really interesting, sidetrack there at the 2-1 buy down part of it. But the bottom line, because our time is a little bit short, but bottom line is I'm very grateful for reading this fact that discount points are not 99% guaranteed, maybe aren't the way to go. And it's a sales tactic in certain ways. So, just like we've always said in every episode, the bad apples are out there. So, you have to ask the questions, and we need to answer those questions. And when people are calling and saying, well, can you do this with a 1% discount point? Yes, but let's educate what all this means. An
Right.
origination fee and a discount point could be the same thing if you're getting the exact same rate. So, let's talk about it. So,
Absolutely. I have to agree with that 100%, especially when you've got customers that are just typing in today's interest rates into the Google machine and they're not seeing the fine print and the rate assumptions and things of that nature. So,
Mhm.
if anybody can take something away from this, is number one, do the math. There is an equation. And number two, read the fine print so that you know what you're actually paying for and what you're getting for what you're paying for.
yeah.
David, you got anything else?
I just want to echo that our emotions don't matter to math.
Yeah.
I
Love it.
I
Pull
think
out
that
your basic kindergarten math, kids.
That's right.
I think that that advice is unbelievably awesome for anybody, no matter what their age or financial aptitudes and things are, is that money don't care. It's math.
Yeah. Yeah.
Facts of life. Fact of life. David, thank you for joining us today. Your insight and wisdom, top notch, brother.
Thank you for having me.
Yeah, well, you'll be back, I'm sure. We gotta
I
find a
love it.
controversial topic and put a Deborah sandwich in here and I don't know what it's going to be. We're going to figure out something though.
That's awesome. Okay, so before we end the episode, David, if you could turn towards Deb, because I'd love to take a snap of like this right here.
Do I get to flip you all off?
Yeah, sure, if you want to. Just one time, turn sideways so I can snap it. Yeah, that's perfect. I love it. Well, guys, hope you have a great weekend. Thanks for joining us again, getting yourself educated with some mortgage real estate nonsense. Or is it?
It's not nonsense.
Totally
All
not.
intelligence.
Okay, you guys. Thank you.
Okay, bye.
Bye.